Advanced Battery Technologies Incorporated, or ABAT, is yet another fraudulent U.S.-listed Chinese stock that the Securities and Exchange Commission should add to its list of targets for investigation. In this report, the result of 2 months of investigative diligence, we present compelling evidence that ABAT is hoodwinking U.S. investors and fabricating the financial statements it files with the SEC. We believe that the company's actual revenue is materially less than the revenue reported to the SEC and that the underlying operations are not profitable. Given that ABAT's SEC filings are fabricated, we're not sure exactly how small the business actually is. We are confident, however, that ABAT should be investigated by the Securities and Exchange Commission for filing falsified financial statements. Since the company is engaging in securities fraud and likely has no intention of providing a meaningful return to public foreign shareholders, we think that the stock is fundamentally worthless. ABAT stock should be delisted from the Nasdaq Stock Exchange. We will follow this outline for parts 1 and 2 of our analysis. ABAT is a China-based company whose main operating business is the manufacture and sale of polymer lithium-ion batteries. In 2009, the company also acquired a business that makes and sells electric and hybrid-powered motorbikes, scooters, and SUVs. In the year ended December 31st of 2010, batteries comprised 55% of sales and electric vehicles comprised 45% of sales. The company went public in July 2004 through a reverse merger. These charts represent the company's historical revenue and EBITDA, according to its filings in the U.S. with the Securities and Exchange Commission. We will provide evidence that these numbers are a fiction. ABAT's corporate structure is simple. ABAT owns Cashtech Investment Limited, which owns 2 key China-based operating subsidiaries. The first is Harbin ZQPT, which manages the Heilongjiang ZQ Power Tech Company, which is the actual operating subsidiary that produces and sells polymer lithium-ion batteries. The second subsidiary that's owned by Cashtech is Wuxi ZQ Autocycle, which we'll refer to as Wuxi. It was acquired in 2009 and manufactures electric vehicles. Prior to ABAT acquiring Wuxi, Wuxi was one of ABAT's largest customers. Businesses that operate in China file their financial statements with the State Administration for Industry and Commerce. Non-fraudulent Chinese companies submit financial statements to the SAIC that resemble those submitted to the SEC. This is not the case when it comes to ABAT. ABAT's filings in China indicate that it is generating only a tiny fraction of the revenue it reports in the United States, and that ABAT generates millions of dollars in losses, not profits. That the numbers U.S. investors rely on in valuing the company are being fabricated. We obtained copies of the Chinese SAIC filings for each of ABAT's subsidiaries and had them translated. The company's submissions to the Chinese regulatory authority indicate that its primary operating subsidiaries are losing money rather than generating profits. In 2009, at an average conversion rate of 6.83 Chinese renminbi to the US dollar, ABAT's main operating subsidiary, Heilongjiang ZQPT, generated revenue of $1.2 million and a net loss of $2.1 million. At the same conversion rate, ABAT's electric cycle subsidiary, Wuxi, generated revenue of only $701,000 and a net loss of $1.9 million. Furthermore, consolidating the business unit filings submitted in China and then comparing them to those submitted in the United States paints the picture of 2 very different companies. In 2009, ABAT reported $63 million in revenue and $21 million in profits in its submissions in the United States to the SEC. This is against $1.9 million in revenue and a $4 million net loss in its submissions to the Chinese regulatory authority. In the case of a consolidated ABAT, the AIC filings show much lower sales and profit than the SEC filings. It's obvious that these numbers aren't simply accounting irregularities or rounding errors. Throughout the remainder of this report, we will demonstrate that the discrepancies are more likely indicate deliberate deceit by management. Selling a commodity product into a competitive market with no technological advantage is difficult. It's especially difficult for a small business with no economies of scale, limited customer relationships, and no distinguished brand name. Yet ABAT had an EBITDA margin of 45% in 2010. One would think it must have some uniquely special competitive advantage. But ABAT, in its own annual report, clearly recognizes that it does not have a special technology for its main products. So it warrants explanation that ABAT purports not just to be surviving, but thriving, with industry-leading margins and returns on invested capital. As a matter of fact, against a backdrop of 106 companies classified by Bloomberg to be in the batteries and battery systems industry, ABAT ranks number 1 in terms of EBIT margins. The distant number 2 ranked company produces 23% EBIT margins. That company is Eiad Industries Limited of India, which is a $40 billion revenue business. ABAT reports a 39% EBIT margin, and this is startling given the industry backdrop. Only 3 other companies report EBIT margins above 20%, one of which is another suspect Chinese reverse merger company. Only 10 companies report EBIT margins above 15%. ABAT also comes out on top in other profit margin metrics, with the number 1 ranking in EBITDA margin and the number 2 ranking in net income margin. ABAT, a company with less than $100 million of sales and a relatively tiny player in a commodity industry, is an extreme outlier in our analysis. But what if ABAT's position in China and access to cheap labor is what gives it such an amazing edge in the global arena? Well, we tested this by comparing ABAT's margins to those of a handful of other Chinese battery manufacturers who would assumedly enjoy the same competitive benefits and could therefore report comparably high margins. Again, though, even in this backdrop, ABAT is an extreme outlier. Research in China, an independent third-party research organization, publishes an annual report titled Global and China Rechargeable Lithium Battery Industry Report. In the 184 pages of the 2009-2010 edition, there is not a single mention of ABAT or any of its subsidiaries. It does, however, make mention of the first 4 companies in this table. We also considered other Chinese battery manufacturers that are not active in the lithium polymer market, such as Causelight Technology International Group Limited and Tianeng Power International Limited. Every one of these companies generated revenues exceeding those ABAT reports to the SEC, and most of them by multiples. Yet per this table, ABAT's operating margin is nearly triple that of its closest competitor and 6 times that of the median operating margin of our Chinese battery makers. Obviously, strong operating performance alone would not normally be cause for concern. But when a company is doing as well as ABAT, investors need to understand why and how, especially given that ABAT has limited operating experience, an unrecognized brand name, and production facilities too small to claim economies of scale. We have spoken to a customer who has visited ABAT's Harbin battery manufacturing plant, and he has stated that there was nothing uniquely special about the Harbin facility. The factory inspector that we hired corroborated this. Yet it seems like no matter how we compare ABAT to its competitors, ABAT's financial figures come out ahead despite the numerous causes for concern discussed elsewhere in this report. The gross margins and operating profit margins quoted for ABAT in the previous slides include both the Harbin ZQPT operations and the Wuxi electric vehicle operations. Had we excluded Wuxi from our analysis, the battery operations segment EBIT margin for 2010 was actually 46%, which is even more inflated than the 39% figure quoted on Bloomberg and shown in our comparable company comparison. This Harbin plant is either the world's most spectacular battery manufacturing facility, or the company's financial statements are a fiction, and we believe it's the latter. But the battery business is not the only miracle ABAT claims. Let's examine Wuxi, the electric vehicle business. ABAT acquired the Wuxi operations in May of 2009 for $10.2 million in cash and 3 million ABAT shares. Wuxi was at the time highly indebted, delinquent on payments to creditors, and in operational disarray. In the U.S., we might say that it was on the verge of bankruptcy. This is a financial summary of the Wuxi operations prior to the acquisition by ABAT. As we can see, the Wuxi operations generated negative operating profit in fiscal years 2007 and 2008, and the last 12 months ended March 31st of 2009. Revenue declined to a mere $749,000 in the most recent quarter prior to ABAT's acquisition, and no money was being invested in capital expenditures. The company had net debt of $9 million at March 31st of 2009 and couldn't generate cash flow to service it, given its operating loss of $3.8 million in the prior 12 months. It had negative working capital of $15.9 million, and it was being sued for non-payment by numerous creditors for delinquent payments of more than $2 million. Yet if we're to believe the SEC financial statements, ABAT was able to rapidly transform Wuxi operations into a world-class electric scooter manufacturer within just a few mere months. This chart compares revenue and EBITDA at the Wuxi operations prior to and subsequent to ABAT's acquisition in May of 2009. In its very first full quarter of owning Wuxi, ABAT was able to turn a money-losing operation into one that generated 19% EBITDA margins. Then, by the first quarter of 2010, Wuxi's EBITDA margin rose by 50% to reach 30%, and by the third quarter of 2010, the EBITDA margin had grown to 40%. Revenue growth was astronomical too. By the final quarter of 2009, the Wuxi operations were generating more than 10 times as much revenue as they had in the most recent quarter prior to ABAT's acquisition. So, a money-losing business that generated $6 million in revenue in 2008 went on to generate $20 million in revenue in 2009, which is the year ABAT took over, and now in 2010, revenue has more than doubled to $49 million. Another astounding performance by ABAT management. It's theoretically possible that ABAT executives are superhuman turnaround experts. It's far more likely that they are lying about their numbers. And unfortunately, findings from our site visits corroborate the latter. Based on data from ABAT's annual report, and as corroborated by ABAT's Senior Vice President of Finance, Dan Chang, ABAT claims to have sold approximately 90,000 electric vehicles in 2010. Now, as part of our investment research process, we sent an experienced factory inspector to the Wuxi ZQ Autocycle production facility to fact-check claims made in the 10K and to speak with factory-level managers. What we found was not encouraging. Factory management indicated that in 2010, 20,000 units were sold. Furthermore, out of 4 assembly lines, only 3 were operational. The facility does not have a motorcycle manufacturer's permit issued by the Chinese government. Management claims to use the VIN numbers of a partner, which is illegal. Staff included 200 workers, but only 20 are office workers, indicating likely weaknesses in R&D, engineering, and quality control. Our investigators' greatest concern was the lack of quality control. The quality control issues described were further evidenced in conversations with various ABAT customers, which we discuss in part 2 of this series. As lacking as the facilities were at Wuxi, the PowerTech site visit was even more disturbing in light of the world-class margins and the company's reliance on this facility to support the bottom line. Our investigators concluded that Harbin's semi-automated processes, while more advanced than some other Chinese battery companies, are far less advanced than battery companies of international standing. He also noted that the CTO of the factory himself acknowledged that it's the battery packagers and trading companies that are making most of the margin, not ABAT, which sells the cells. Unfortunately, we were not able to photograph the interior of the facility. Our investigator requested permission, but pictures were not allowed. Please refer to video 2 of this series for additional evidence in support of our thesis and concluding remarks.